The US stock market is now about 15% off the highs set earlier this year. We'll check in on price movements and then zoom out to better understand how markets tend to perform after a decline. Before we get into the markets, the Consumer Price Index, or CPI report released this week, indicated that overall price levels increased 8.3% compared to a year ago. Although this is a decline from a month ago, the inflation level came in higher than expected, partly due to the shelter component, which continues to increase. Daily stock prices have been wobbling around more than usual lately, and overall prices have been trending lower. To help put some perspective on this, we'll look back at history. Let's look at single day price movements greater than 2% up or down. What we find and what this graph helps show is that larger stock price movements tend to be clustered together in time. Some recent examples of this were early 2020 when COVID hit, the great financial crisis of 2008 and 9, and the technology bubble of the late 1990s. These are all examples of how larger price swings tend to be bunched together in time. Importantly, we recognize that the same large price movements that negatively impact investors on the way down are close neighbors to the large price movements that benefit investors on the way up. Now let's zoom out of the day-to-day movements and look at longer time periods, acknowledging that we are in the midst of a market decline. Often the question that comes into investors' minds is, what will happen next? We'll address this today by looking at what has occurred historically during periods of market declines. And we can't predict the short term, however, we do believe that history can be a guide. We find that after a market decline, markets have historically delivered strong positive returns moving forward. For example, and as we can see here, after a 20% market decline, the ensuing 3-year results have averaged around plus 40%, and the 5-year results around plus 70%. Intuitively, we know that broad markets will recover at some point. After all, 100% of the time, the US stock market broadly has fully recovered from historical declines and made new all-time highs. To summarize, larger price swings up and down tend to be clustered together in time. Selling or exiting the market risks missing out on potential returns. And zooming out after larger market declines, the ensuing 3- and 5-year periods have historically been quite strong for stock markets.